Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, as you know, at the beginning of every year or at the end of the previous year, we get a lot of market predictions. Most institutions and money managers and analysts, or many of them, I should say, give market forecasts, give various predictions on what, for example, they think the equity market's going to do, what the bond market's going to do, what the real estate market's going to do, what's going to happen with inflation, just to name a few areas. But you tend to get a certain percentage of those folks who are optimistic, and let's call them bulls, and a certain percent, and in my opinion, a smaller percent, tend to be negative, pessimistic, or bears. We're going to talk a little bit about two contrasting points of view for 2023. And the question is, who is going to be right? And this is not necessarily about these individuals or the institutions that they represent, but it's more about one's opinion. And ultimately, the question is, what do you do if one is right and one is wrong? So what do you do to adjust your portfolio and to address, the concerns that may come about? Let's dive in. So 2023, bulls versus bears, who will be right? Of course, at the end of the day, time will tell. Well, Mr. Yardeni, who runs one of the more reputable equity strategies in the US, recently was interviewed in Bloomberg, and he shared his position that the bull market and the outlook for the world economy is positive and improving, and he believes that the equity markets made a low last October, so October 12th of 2022, and he believes that was the end of the bear market. And you may recall, and if you're closely paying attention, this is where the market actually double bottomed again mid-October of last year, and we have seen a rebound, and obviously we're off to a very good start. So Mr. Yardeni's position is that he thinks that investors right now are more optimistic about the global economy and looking where values are still cheap. In other words, he's realized obviously the equity markets pulled back, and his position is investors are looking for value, discounted opportunities and starting to deploy money. And that's, at least most recently, you've seen that simply, in the indices and individual stocks. They've appreciated quite nicely year to date. He goes on to say, we've already begun a big run in China, now looking at Europe. The plunge in natural gas prices in Europe suggests that they may not have a recession, and China should be open after abandoning its restrictive COVID policies, strengthen its economy. So he's interpreting the data, and what's interesting, of course, is, and we all know this as human beings, there could be the same set of data that two different people interpret totally differently, or I should say maybe Mr. Yardeni tends to be maybe a more optimistic or a bullish guy, if you will, or money manager. So maybe he's looking for data to support his beliefs. Ultimately, of course, we're going to see who's going to end up being right. But to contrast his point of view, let's look at another totally contrasting point of view. And this is from actually one of the top Wall Street banks, Morgan Stanley, the chief investment officer. He was recently interviewed by Fortune, and he says, well, actually, I don't believe the market's going to be good this year. So totally opposite perspective. He thinks stocks have more to plummet, an additional 20%. Now, of course, he said this actually at the beginning of the year when the markets were not as high as they are now. So in his position, and he thinks that things are going to be challenging. We'll get to why in a minute, but he's ranked the number one stock strategist in the latest institutional investor survey. So obviously he's got some credibility, at least with the the investment industry. His belief is investors are not prepared for how bad things could get, and his belief again is the S&P was susceptible to drop around the $3,000 price level. Now we're at around a $4,000 price level, just to give a rough number as the time of this recording. So that just gives you an idea of, what may be ahead of us. And he says, even though the majority of institutional clients think we're probably going to be in a recession, they don't seem to be afraid of it. That's just a big disconnect. And what he means by this is, in his conversations, he's saying people are quite pessimistic about the markets, the economy, and multiple reasons. Again, one of the concerns, of course, is persistent inflation, even though it's come down recently. Obviously we have higher interest rates. We have company earnings that are mixed at best, and even companies, of course, laying off folks. But his position is, yes, we're having these conversations where various institutions are maybe not as optimistic, so let's just call them pessimistic, but in terms of their portfolio allocation, they're not making the adjustments to the portfolio allocation that is consistent with their concern. So from a, let's call it, protection of capital or hedging standpoint. So for example, maybe even though, again, they're concerned about things, their portfolio still is maybe more growth oriented, more risky. That's what he means by a disconnect. So he goes on to say that this coming earnings season, which actually we're in the midst of right now, could create volatility in the markets because many corporate financials were likely to come in below expectations. Of course, we've had a mixed bag. You see, for example, Microsoft and Tesla recently reported, mostly mixed there. And that's another areas that investors are being a little bit complacent about, really, which are the costs that are increasing faster than the net revenues. He mentioned when he recently spoke with CNBC. When we actually talk to people, they're bearish, but it's not really consistent, meaning he's saying they're not really positioned as if they're bearish. So again, his position is things are going to be bad and going to get worse. We'll end up seeing if he's right or if Mr. Ardeni's right. So the question is, what do you do? For example, what do you do if markets do tend to be softer, or even we have a persistent downturn in this bear market? In my opinion, you go back to what your goals are. Create your very clear, well-written, defined goals. For example, maybe your goal is to retire in 5 years, or maybe your goal is to retire in 1 year, or maybe you are retired, but you don't want to have a down portfolio like you did last year, or at least not down as much. So maybe you redefine what your goals are, and that ties into your risk tolerance. So if you were in, as an example, high-tech growth stocks, you probably were down 20 to 30%, maybe in some cases more. Maybe you want to pull down the risk in your portfolio. So what's your risk tolerance? Getting clear on that. Again, making sure your financial goals and your risk tolerance are showing up in terms of how your portfolio is allocated and what your portfolio strategy is. And as noted here, make adjustments given market conditions. So as we noted earlier, we had a very severe, at least if you were in the NASDAQ, peak to trough, the NASDAQ was down over 30%. That's a pretty severe downturn. So maybe you don't want to suffer that. If things get worse, maybe you don't want to suffer those losses again. So reconsider your investment strategy. Maybe we have, Mr. Ardeni's position, maybe we have seen the bear market lows in October, and we are at the start of a bull market. So do you now still hedge? Maybe you start taking off the protection, and maybe we're going to start into a new bull market. So depending on what kind of market we're in, you adjust your portfolio given the market conditions. So ultimately, again, at the end of the day, our position is the portfolio strategy is driven by your goals and risk tolerance. In an ideal situation, what that does for you, again, an ideal situation, it creates confidence and clarity in today's challenging financial markets, where you don't get distracted by maybe a negative headline, or maybe the Fed comes out, the Fed has a meeting quite soon, and maybe they roil markets with maybe a surprise interest rate hike. They've been talking about a 25 basis point hike. Maybe they surprise the market with 50 and the markets sell off, hypothetically. But if you have a portfolio strategy in place, my belief is that you're not going to get shaken out, if you will. You're not going to get scared to maybe make an emotional decision, which ultimately may not benefit you in the long run. All that to say is, if you would like a second opinion on a portfolio or financial situation, you can go on our website at nicholswealth.com. In the upper right-hand tab, this request an appointment. You can click on that, fill out the information, and one of our advisors will reach out to you, schedule some time to chat, and see if we could add value and answer your questions. Thanks again for watching.